This is Ask Yahoo Finance Anything, and we mean anything. I'm here with a powerhouse panel ready to answer your personal finance questions. Jeffrey Levine is Focus Partners Chief Planning Officer. Rhian Horga is founder and CEO of retirement platform Silvur, and Lazetta Rainey Braxton is founder and CEO of Lazetta Associates. You've sent in questions on student loans, retirement, credit cards, even buy now, pay later, and we've got answers to help you get your finances in order. And reaching that goal often starts with saving. And there are a lot of options out there for online savings accounts, and a lot of people don't know where to start. So, jump ball question, where to start with online savings accounts?
Well, I think the very first thing is how much you're going to be putting in and how important is mobility of that money for you, because there are some very high yield options that sometimes are a little bit more difficult to get money into and out of. If you don't need that money right away, you can afford to put some money aside into one of those options. But if this is going to be very much like a slush fund almost, right? Like income comes in, money goes out to pay your checks, then or your bills, then at that point you really need to focus on what is the most seamless way for you to do that so that you can focus on doing your job, raising your children, all the other things that are more important in this world than managing the day-to-day checkbook.
So, Rhian, I know a lot of people focus on like the APY, right, the annual percentage yield. Is that something they should pay attention to as well?
Yeah, look, I think when you think about APY and you think about yields in general, what you're really trying to think about is how long are you holding the assets. And so really trying to get I think kind of double tapping on that prior comment, which is this more medium-term capital? Do you need to be able to access it over the next 6-12 months, or is this kind of daily liquidity money?
Yeah, so I think also there's a lot of fees attached to some of these accounts, and there may be limitations on the number of checks you could write. Is that true?
Well, a lot has changed since then. I love my clients being in a high yield savings account earning that 3.5% or more. I mean, there was a time where it was like 50 basis points, I remember, a decade or so ago. So I don't see the fees and the transactions cost as much as I used to. I think, the financial services are really wanting these people to come to their bank and be competitive.
Yeah. What about like the difference between someone getting a promotional yield and like the yield that you actually get after the promotion's over? Do people need to know about that sort of pull the rug out from under you?
I think it's just being mindful of it, right? There's nothing wrong with a promotional yield, but if you're getting that promotional yield when that promotion is over, if this is longer term money, then that may not be the place to keep your dollars anymore. It may be time to look for another promotion. Now, again, of course, if we're talking about large amounts of liquid dollars, then that can make a lot of sense. But if we're talking about smaller sums, again, I think sometimes people overreact, right? Like at the end of the day, if you shop for your rates and you get 1/4 of an eighth of a tenth of a percent more across the street, how much is the bang for your buck worth it? And is there other things that you could be doing to be more mindful with your time and grow the top line more?
Yeah, I remember my mom used to go from one grocery store to another because she had different coupons at different places. But for her,
but there are a lot of people today that still have a lot of different IRA CDs because every time one came due, they look for the top rate across the board, and getting that top rate is more important to them than consolidating it. And that's just a personal, it's just a person by person decision.
Yeah, so the other thing that we got from listeners was this notion of credit card points and people chasing credit cards and racking up points and trying to get the best deal for their credit cards. Any thoughts, Rhian, about
Yeah, I mean, look, I think just the transparency is really hard, right, as a consumer today. And I think, as we see the credit card fees going up, I think the consumer is looking for value. And I think the question is, where are you getting the most value? Is it worth paying the $200, $300, $400 and getting these points? Like, are you going to use them? Or are you actually better with a more of a no-frills card? And I think that's where I think as the consumer, you need to be a lot more focused on, are those perks actually worth it to you?
Yeah.
And what you were kind of commenting on, there are some people who are specialists. They do it as a job and really work the kind of credit card system. What I say for my clients is back to what's most important to you. Do you enjoy traveling? Get a travel card. You want money back? Get a money back card, and be very mindful of paying it off every month so that you're not incurring those high double-digit
Yeah, I was going to mention that, Lazetta, right? If you keep your balance, it almost offsets the benefit of having the points, right?
Exactly.
Sure. Yeah, I think you really hit on the point, which is pay your balance off every month and understand yourself, right? If you're someone who is not going to pay that off every month, then you might actually be better off with a debit card, even if you don't get the same amount of points or something like that, making sure that you don't outspend what you have. But if you're someone who has, let's say, the ability to pay that off each month, then points are effectively free, right? Then at that point, it makes sense to use them and find the card that's best for you.
Yeah, so another question we got from listeners was around whether I need a financial advisor or not. And I know I'm talking to a group of financial advisors, so the answer may be biased here, but what are your thoughts, Lazetta?
I'm a fiduciary. Of course, I can't be biased with that response. I, in all seriousness, do believe that there has to be a good fit. If someone is really good at financial planning, have gotten the tricks, the ropes, and reads upon it, then the answer is no. You hire out when you want extra time, right? You want somebody else to do the work for you. You want a dialogue partner. And you want somebody just to manage, help manage your life along with you. And I say life, not just investments, because it's very holistic in the approach from the way I think about it.
I think also today, the American consumer has so much more choice, right? They can start their research journey themselves independently online and do that research. And we see a lot of folks talk to family and friends, right? I do think that parts of retirement, as an example, are very social. You retire around the same age as your family and friends, so you swap tips. But I think in these moments where you have these big decisions where it's hard to backtrack, that's where bringing an expert in can be really helpful. And so I don't think it has to be all digital or all human. I do think that there is this hybrid, which is do your research, get informed, get that information, and then go get that expert to help you make that final decision so you feel really confident.
Yeah, I often say emotion is the enemy of good decisions. And it's very difficult to divorce yourself from the emotions that are associated with your own decision making. I mean, I like to think that I am fairly knowledgeable and that I understand financial planning to a decent degree, but I have my own financial planner because I cannot remove emotion from my own decision making process. And so for me, a lot of times it's just having someone else to say, am I thinking about this correctly? Is there something I'm missing? Or am I letting my emotions get the best of me? In which case, if I am, it's probably not the right decision long term.
Yeah, okay. Another pocketbook issue that is on the minds of people is this notion of car payments, and we're witnessing right now delinquencies on the rise. What can people do to sort of mitigate and manage the ill effects of that?
That's such a tough question because people are getting squeezed. And so when it comes to credit, you start with the creditor and say, okay, this is my situation. Are there any options, right? Start with the person you're working with. And then two, you might, have to have it repossessed. That is the worst case
Nothing
scenario.
Worse than the repo man
I
coming
know, I know.
in the middle of the night to take your car.
And we also have to make it reality that some people have to do the reset. And so if you do have to do the reset, know what that means for your credit report, your credit score, and the like. Information is key, and no, it's not the end of the world. That's not the desired, but it could be the case.
Yeah, there might even be other options where if you have a more expensive car, can you turn that in if you're financing it and maybe go to a less expensive car? May not be your preferred vehicle, but it might be better than having to make, $1,000 a month payments. And I think, Bob, the bigger issue here is setting these up front, right? Like if you're someone who is going to make a $1,000 car payment, you got to have enough reserved in your liquid cash, maybe going back to having a checking account, right? That has a liquid dollar so that if something bad happens, that you have the ability to continue to make these payments. You shouldn't go on thinking that everything that exists today will always exist in perpetuity. Most things change over time and hopefully for the better, but sometimes that's not the case.
Yeah. So a question, it didn't come in from a listener, but it's a question I get all the time from my children and my children's friends is when they switch jobs, should they roll over the 401k from their former employer to their new employer or into an IRA or leave it behind? Tough choice, right?
Yeah, I mean, maybe I'll kind of jump in there. I see it through my own employees, and what really impresses me today is I actually see employees being more active in that conversation and consolidating. I think the challenge of having lost IRAs and not simplifying is a huge problem. Most plan participants today do have the option to bring their 401k to their new employer. And so whether it's rolling over to an IRA or just rolling it to the new employer, keeping it in one place, right? This spaghetti of retirement savings in lots of different places, it ends up with people typically being underinvested, not remembering what they have, and I think it makes
track of what they had, right?
Exactly.
Because
I mean,
there are a number of
these like
their address.
Yeah, particularly, and I mean, we see this, like, your email address when you come out of school is likely different than the email address you're using 20 years later.
And maybe deleted by your school.
I just think simplicity, to be so you can track it, is so much better.
Yeah, I mean, it's so bad that Secure Act 2.0, that retirement bill that we had just a few years ago, created the Department of Retirement Lost and Found. I mean, it sounds like a made-up thing because it's so silly, but that's how many people are not keeping track and end up, losing track of their dollars in retirement accounts. So I do think, to your point, that most people are better off, whether it's for easier consolidation and just when you get to retirement age, required minimum distributions, only having to go to one place, whether it's managing the money in a more efficient manner. But there's always exceptions to the rule. I mean, we're here today in New York City. New York City school teachers get an automatic 7% return if they go into their fixed option, right? Like, that is very unique to that plan, but every plan has something a little bit different. If you're getting 7% guaranteed in your fixed option, there's not a better bond option out there today. So that would be one of the exceptions to the rule, or maybe you do leave your money in the plan. It's why we have jobs, right? Is to help people make these decisions.
All right, so the reality of it is, and no names here, but a close friend, should I call her, says it's just too hard to take the money from my former employer's 401k and move it into either my new employer or into an IRA. She's overwhelmed by the process.
Yes, and the key is staying with it, because it's your money and it's your life. Yes, of course, no one wants to give up money for any reason. I'm specifically saying institutions, and it is a process that has been going on for quite some time. So get on the phone, find out the forms, figure out who your key people are, document what's happening, follow through. It's your money, it's your future.
I want to double tap on the get on the phone, because it seems so old school these days to say that. But I know, so I worked at JP Morgan for a long time, and when I left JP Morgan, I rolled over my 401k, and I did not understand the paperwork myself. Like, it was complicated.
Yes.
And so I got on the phone because I wanted to make sure it was done correctly. And I think those lifelines are there. Even those of us that are experts are reading this paperwork, and it is not written for the average human being.
Yeah.
So pretend it's like Who Wants to Be a Millionaire, and that you get to call a friend.
Yes, for sure. But these services are here for you, right? Just take advantage of it.
Yeah. All right. Let's go over to Allie Cannell in the Social Center with some viewer questions now.
Thanks, Bob. Such an important panel, and we have plenty of viewer questions coming in through social media. And Rhian, this first one is for you. And fair warning, I'm sensing a bit of sarcasm in this first question. But Damien asks, I totally know all the really important things to know about IRAs, but I just want to make sure you know them too. So what are 3 IRA rules that everyone should know?
All right, well, this is really timely because this morning the IRS came out with their annual updates, and I've got the numbers right here with me, but I think, I was gonna say, so the first thing I really get everyone to think about is actually the arbitrage between your Roth contribution limit and the Roth 401k. I think for those of us that are a little bit older, we don't even remember the Roth 401k, right? It's a newer concept, but you can put over $24,000 into a Roth 401k, whereas your IRA is capped at, or your Roth IRA is capped at $7,500. So that's like a real winner for someone who's maybe maxing out their IRAs and hasn't looked back to see if their employer has that option. The employer might not have had the option 5 years ago, and they probably have the option today.
And no income limits too, right?
Exactly. So there's no income limits, which is fantastic. Second thing I'd be thinking about is there's a lot of conversation about money going into IRA accounts, but it's really thinking about money coming back out. And I think one of the challenges that a lot of older Americans find is that all of a sudden they've got savings, hopefully in those accounts, and now they start to think about taking money out. Do they get tripped up by some of the surcharges for Medicare? And so really understanding that when you take money out of your retirement accounts, you have to really be thoughtful about the timing of doing that. The last thing I would say is for folks that are kind of in between those last couple of years for retirement, the Secure Act 2.0 gives you an extra supercharged a catch-up contribution. That's brand new. It went live last year, so make sure you're taking advantage of that super catch-up if you can.
Yeah, so people who are age 50 and older can contribute up to $8,000, but if you take advantage of the super catch-up for people 60 to 63, it's $11,250.
Yep, that's the number from this morning. Exactly. I was just triple checking it.
Got it right here.
Yes.
So.
I love it. I'm taking notes. And Jeffrey, I have a new one for you. Josiah asks, I have a mortgage at 7% interest. I often have $500 to $1,000 left over to save at the end of each month. I have a kid and a spouse. Should I prioritize paying down my mortgage or invest in the S&P 500?
Yeah, this is a great question, and I know the answer is not going to be very satisfactory, Bob, but it depends. How did you know? That's exactly right. Unbelievable, right? Well, the answer is it depends because you have to look at the relative benefits of each and what is most important for you. So investing in an S&P 500 fund, over time you would expect to do better than 7%. Now, there's some questions here. If you're looking at paying down your mortgage, are you able to deduct that interest? If you are, then it's not a true 7% cost to you each year, right? It might be 6%, it might be 5%. Some of it depends upon your tax rate. So doing something that sort of beats it over the long term, like investing in the S&P, would be easier, if you will, right? You should have a better opportunity to beat it. But here's the thing, paying down your mortgage is a guarantee, right? So there's that on the other side. But if we're looking at liquidity, paying down your mortgage, very hard to access that money if you want it, right? If you have an issue and you need to, going back to the car payment, right? If you need to make that car payment, very difficult to say to the car company, here's my living room. Are we good this month? Like that doesn't work very well. You need cash. So if you're in the S&P 500, turning that into cash is a lot easier. Yeah. So it's really looking at the totality of this and saying, what's more important to me? Is the liquidity more important? Is the guaranteed return, if you will, of putting money in? And it doesn't have to be all or nothing.
Right, can split the difference.
That's right. There's nothing that says you can't do some to pay down your mortgage a little bit faster and some to, and some in the S&P 500. It doesn't have to be an all or nothing decision.
Allie, what else you got?
All right, this last one is for Lazetta. One of our viewers on GOTV asks, for beginners, what's the first step to take when thinking about investing? Should I start with stocks, mutual funds, or something else?
I love the fact that I'm hoping the one who's asking that question is already invested in a retirement plan, because now it's so easy to know what you're invested in the market through that. And you can have the index and you can have active, but a lot of people still go the index way because it's just easier in terms of performance. So maybe you want to match what you're invested in your 401k, be it index S&P 500 and the like. Do the same thing for your brokerage taxable account. And if you really, really love the stock market, or say you really, really love a company that you're spending a lot of money on, maybe you do want to dip in and buy a few shares as an investor and not only a consumer of that company.
Jeffrey, Rhian, Lazetta, thank you for being with us at Invest, and thank you